Welcome everyone to today's report, the 30th of May. Right. Today I want to talk about this topic, central banks and the limits of debt financing. Now, the Japan's debt to GDP ratio has long exceeded the 200%, yet this economy has avoided crisis. The US wants to use Japan as a model, saying that since Japan can do it, why can't we have debt surpassing their income? Okay, Japan has surpassed by 200%. Now, this is not due to economic strength, but Japan, the difference is the structural characteristics. Now, most of the Japanese government debt is held domestically by the Japanese bank, pension funds, and especially, the Bank of Japan, which as of 2025 holds about 46% of all Japanese government bonds. Bonds is like IOUs, okay? Now, because the Bank of Japan returns interest payments to the government, is able to sustain high debt at low cost because I'm returning back to the government. But this dynamic right now, even though that has been the past, this is now shifting. Inflation is rising in Japan for the first time in decades, and the Bank of Japan is basically scaling back its bond purchases right now. It still controls the 10-year and the short term, but the higher ones, the 20, 30, 40, it leave it for the market to decide. And the moment the market makes its own decision, it started shooting up already. So now Japan has to deal with this issue, whereby the yields are increasing and the financial system, particularly the insurers right now, and the pension funds is showing stress from unrealized bond losses, just like what happened in the US, the small banks. Now this happening to all the Japanese insurers, pension funds right now, they're showing paper losses because they cannot just sell the bonds. The prices of the bonds have crashed already. Now, Japan's ability to sustain high debt through central bank support is now being tested. Even the the prime minister saying that Japan's condition is worse than Greece, So in contrast also, like the US Federal Reserve holds about 22% of Treasury securities, only 22%, down from the peak of 35% during the pandemic. So with the Fed stepping back, and the US must rely more on private investors and foreign governments to finance its debts. That means foreign outside factor to go and buy its bonds. So as inflation remains elevated and bond yield rise, investors are becoming more cautious. They are not buying as much as well. Same thing with the Eurozone over here. The European Central Bank has stopped investing in maturing sovereign bonds, reducing its role as buyer as well, and forcing individual nations to turn to market financing. Market financing, same meaning, getting investors from outside. So this is what all these major central banks they are facing. Now, the difference between the Eurozone and the rest is that the Eurozone countries borrow in a currency they do not control, because it's a collection of countries that form the Eurozone, as opposed to US and Japan. They only have one, and the decision easier. So this limits their flexibility and heightened risk during financial stress as well, because the debtors are not as forgiving, because they are finding other people to lend to them, not from their own country. So they also face this issue. So Japan's model has acted like a buffer where the central bank is actually absorbing all volatility, whereas the US enjoys the global status of a dollar, and its treasuries is more exposed to market forces. So as borrowing costs rise and foreign demand weakens, the US must tread carefully to maintain this fiscal credibility right now that's being threatened. So can the US follow the Japanese model? That is the question right now. Now, in theory, US could expand Fed bond purchases again. They can follow like Japan. It did so during the 2020 crisis, pushing its balance sheet above 35% of GDP. But today's condition is very different. The US is not in a deflationary slump like Japan was, because when you're in deflation, the interest rate stays very low. Japan had even negative interest rates, so no problem. They still can balance it off, but US always had a positive inflation, and it has been persistent. So if US were to do large-scale bond buying, it would inject liquidity, pushing prices higher and undermining the Fed's credibility once again. So the market might worry that the Fed is directly funding these government deficits, which could reduce confidence in both the US dollar and Treasury bonds over here, right? So unlike the Bank of Japan, Fed operates in a highly globalized, political sensitive system. So right now, what we're going to see is that if there is any aggressive bond buying, there will definitely be political backlash and currency instability and foreign investor pullback. They had already suffered this when Japan did it on that. That's why Trump pulled the handbrake after I gave a 90-day reprieve, because that was done by Japan. They actually dumped it. They had to go and protect their own country itself. So Japan's domestic saving base and deflationary conditions made its model viable, because Japanese as a country, they don't simply spend. Even their own people, they don't simply spend. There's more of a saving nation than a spending nation, as opposed to US. Actually, they like to spend a lot generally. So again, even the population also, they have different kind of culture. So one is a spending culture, one is saving culture. So it's not that easy for US just to copy Japan. So you get rid of this. Okay. So in this high debt, high rate environment, US basically what you want to do, if you still want to invest in this particular environment, right? Then you would need to look, if for the stock market, you will need to look into stocks that is of value rather than growth stocks. If anyone asks, so sectors like energy sectors, consumer sectors, and financials, they perform better than rate-sensitive tech firms. So tech will suffer, the Magnificent Seven all. So these companies have stable earnings, can pass on the cost during inflation. So if you're in stocks, you can look into these areas. So investors also turn to real assets during this period when there is instability, such as real estate, farmland, and infrastructure, which tends to appreciate with inflation. And also this particular area called Treasury Inflation Protected Securities, or TIPS, which protects purchasing power. And also if short-term bonds, because they don't carry that much risk as long-term bonds. Okay, these ones are those areas that people can look at. So to put in simple conclusion, can the US sustain its rising debt in the short term? Yes. Its currency, market debt, and global role can buy its time. But debt cannot grow indefinitely without consequences. The same with the rest of the world, in Europe as well. So as usual, if confidence falter or interest rate costs crowd out public investments, the US will face difficult trade-off. That means the higher taxes, financial repression, or inflation. So times has changed definitely. And Japan is no longer the quiet model of debt stability as well. Okay, with the bond yield rising, the old playbook is also being rewritten in Japan, and Eurozone still relies on the ECB to step in and support weaker countries when they struggle to borrow or face financial troubles, right? So the US definitely is a league on its own, but the privilege is finite. The why there's league on its own, because of its status, currency reserve status, that's all. That's why they need to protect this as much as possible. And that's also one of the reasons why I said that the cryptocurrency is pushing up, because they want to push this stable act, to recognize the stable coins. Because mainly all stable coins is traded in US dollars. Okay, so once they're able to push that, it does help them. So that can go on, but eventually something yields. It's either growth, currency strength, or market trust. Either these three, one will give up. And the America's unique position delays that reckoning, but does not cancel it. So now the real question is this, is not if the US hit its limit, but when and how it chooses to respond. And it's not easy with what's going on, because they have been enjoying this status for so long, that once you're so comfortable in a position, you don't change that easily. And that's why you're seeing so much tension going on in the US, with these court cases ongoing. So this won't happen that fast. If anything, just be prepared in the next few months, probably 2026, then be a bit careful. But we will have more news by then. Okay?